Hello, welcome to Capital Sensei. Today, we're going to dive deep into one of the most practical and empowering investment books ever written, One Up on Wall Street by the legendary fund manager Peter Lynch. We'll explore his core idea that you, the average person, actually have an advantage over the pros. We'll break down his 6 categories of stocks, learn how to find those life-changing 10-baggers, and understand the simple yet powerful research techniques you can use before investing a single dollar. Whenever we can, we try to answer questions and get a good discussion going, right there in the comments section. It's one of my favorite parts of making these videos. So, as we go along, if a question pops into your head, or if you have a story about an investment you spotted in your own life, please share it. Your experience could be the exact thing someone else needs to hear to have their aha moment. So, let's get straight to the heart of Peter Lynch's philosophy. His central message is almost revolutionary, especially when you think about the mystique surrounding Wall Street. He argues that the amateur investor, the person on the street, has a built-in advantage over the massive bureaucratic Wall Street funds. Now, how can that possibly be true? These firms have armies of analysts with PhDs and supercomputers, right? Think of it like this. Imagine a big-shot food critic from New York City flies into your town for one day to review your favorite local restaurant. He'll eat one meal, take some notes, and write a review. But you live there. You've eaten there dozens of times. You know the owner. You know which days the chef is on fire. You know they get their vegetables from the farm down the road, and you've seen the line out the door getting longer every single month. Who has the better, more complete picture of that business? You do. That's the amateur's edge. Wall Street professionals are often disconnected. They're managing billions of dollars, so they can't invest in small, interesting companies because it wouldn't even move the needle for them. They're also under immense pressure to show short-term results, so they might miss a great company that will take a few years to truly blossom. You, on the other hand, are free from these constraints. Your greatest source of investment ideas is right in front of you. Your job, your hobbies, the mall, your neighborhood. This is where Lynch introduces the concept of the 10-bagger. It's a term he borrowed from baseball, where bag refers to a base. A 10-bagger is a stock that increases to 10 times its original purchase price. If you invest $1,000 and it becomes $10,000, you found a 10-bagger. These are the investments that can truly change your financial life, and Lynch insists they are not found by staring at complex charts, but by observing the world around you. He tells a famous story about his own wife. She came home one day raving about a new brand of pantyhose she bought called Legs. They were sold in supermarkets and drugstores in these cool egg-shaped containers. They were good quality and they were convenient. Lynch, the Wall Street pro, had never heard of it. But he listened, did some research on the parent company Hanes, and it turned into a 6-bagger for his Magellan fund. The initial clue didn't come from a computer screen. It came from an everyday experience. So where do you look for your own 10-baggers? Start with your profession. Are you a doctor who's noticed a new medical device that's saving lives and cutting costs? Are you a software developer who sees all your colleagues flocking to a new productivity tool? That's your edge. You understand the industry better than 99% of Wall Street analysts. You have the local knowledge. Or look at your hobbies. Are you a passionate cyclist who's noticed one brand of bike or component is suddenly everywhere and all the serious riders are talking about it? That's a lead. Did you just renovate your kitchen and discover a fantastic new flooring material from a company you'd never heard of? That's another lead. The world is constantly giving you stock tips. You just have to learn to see them. Lynch's point is that by the time a hot company is being discussed on financial news channels, the biggest gains have often already been made. You want to find them earlier. But, and this is a huge but, spotting a good product is not enough. This is a critical distinction. Liking the new iPhone doesn't automatically mean you should buy Apple stock. That's just step one. Step one is the idea generation. Step two is the investigation. And before you can properly investigate, Lynch says you need to understand what kind of company you're looking at. This is probably the most useful part of the entire book. He breaks all stocks down into 6 distinct categories. Let's walk through them, because knowing the category tells you what to expect from the stock and what to look for during your research. First up, we have the slow growers. These are the big, old, established companies. Think of a massive utility company or a major food brand that's been around for a century. They're like giant redwood trees. They're not going to grow much taller, but they are incredibly stable and unlikely to fall over in a storm. These companies typically grow just a little faster than the overall economy, and their main attraction is that they usually pay a reliable dividend. You don't buy a slow grower expecting it to become a 10-bagger. That's not its job. You buy it for stability and income. When you're looking at a slow grower, the main thing to check is the dividend. Is it consistent? Have they been paying it for years? Is it well covered by their earnings? You're not looking for explosive growth here. You're looking for dependability. Next, we have the stalwarts. These are also large companies, like a Coca-Cola or a Procter & Gamble, but they still have a bit more room to grow than the slow growers. Lynch loves stalwarts. He considers them the backbone of a portfolio. They aren't going to give you those lightning-fast 10-bagger returns, but a good stalwart can still provide a handsome profit. If you buy one at a reasonable price, you might see your investment double or triple over a few years, which is fantastic. Plus, they offer great protection during recessions. People still buy toothpaste and soda when the economy is bad. When analyzing a stalwart, you want to look at its price-to-earnings ratio, or PE ratio. Don't let the jargon scare you. The PE ratio is just a simple way to see if a stock is cheap or expensive relative to its profits. Think of it as the number of years it would take for the company's profits to pay back your initial investment. For stalwarts, you want to buy them when their PE ratio is on the lower end of their historical range. You're looking for a good company at a fair price. Now for the exciting one, the fast growers. This is 10-bagger territory. These are typically smaller, aggressive, new companies that are growing at incredible rates, say 20 to 25% a year. They're often in growing industries and are rapidly expanding into new markets. Think of a small, successful restaurant chain that's just starting to open locations in other states. This is where you can find those life-changing returns. But with great potential returns comes great risk. Fast growers are volatile. Many of them will flame out and fail. For every Amazon, there are 1,000 pets.coms. So when you're looking at a fast grower, your research has to be top-notch. The key question is, can they keep the growth up? You need to check if the product that's making them successful has long-term potential. Are they expanding their earnings while they expand their sales? And most importantly, check their balance sheet. A fast grower with a lot of debt is a ticking time bomb. You're looking for one that is financing its growth with its own cash flow. Our fourth category is the cyclicals. These are companies whose sales and profits rise and fall in a regular, often predictable cycle. The classic examples are airlines, automobile companies, steel companies, and chemical companies. When the economy is booming, people buy new cars, travel more, and build more things, so these companies make a fortune. But when a recession hits, their businesses can fall off a cliff. Timing is everything with cyclicals. It's the complete opposite of a stalwart, which you can buy and hold. With a cyclical, you have to buy them at the bottom of the cycle, when things look terrible and the news is awful, and sell them at the top of the cycle, when business is fantastic and the experts are all bullish. It's counterintuitive and very difficult to do. Lynch warns that amateur investors often get this backward, buying high and selling low. You have to be very aware of the economic conditions to succeed with these. Fifth on the list are the turnarounds. These are companies that have been beaten down, battered, and left for dead. They've been hit by some major problem, a bad business decision, a scandal, near bankruptcy. The stock price has collapsed, but there's a chance for a comeback. Maybe they have new management with a brilliant plan. Maybe they're about to be bailed out. Maybe they've sold off a failing division and are now focused on their profitable core business. Turnarounds are not for the faint of heart. They are incredibly high risk. But if you can correctly identify a company that is truly turning the corner, the rewards can be enormous, often rivaling those of fast growers. When looking at a turnaround, the first thing to figure out is, how are they going to survive? Check their cash and their debt. Do they have enough money to execute their plan? Then, what is the plan? Is it credible? You're basically betting on a comeback story, so you need to believe in the plot. Finally, we have the asset plays. This is Lynch's most subtle and interesting category. These are companies that are sitting on something valuable that the market has completely overlooked. The value of this hidden asset might be worth more than the entire company's stock market valuation. What kind of asset? It could be anything. It could be real estate. A struggling retail company might own all of its stores, and the land they sit on is suddenly worth a fortune. It could be cash. Lynch tells stories of finding companies that had so much cash in the bank that if you subtracted the cash from the stock price, you were essentially getting the entire operating business for free. It could be a valuable brand name, a patent, or even a hidden division that's incredibly profitable, but overshadowed by the rest of the struggling company. Finding asset plays requires some real detective work, digging through a company's financial reports, specifically the balance sheet. It's like a treasure hunt. So once you've found a promising company and you've identified which of these 6 categories it belongs to, what's next? You can't just buy it. Lynch is adamant about this. The idea and the category are just the beginning. Now you have to do your homework, or what he calls kicking the tires. And he provides a simple 2-minute drill to start. Before you get lost in the numbers, just ask yourself 2 questions. First, what is the story of this company? In 1 or 2 simple sentences, explain why you think this is a good investment. If you can't do this, you don't understand it well enough. Second, what needs to happen for this company to succeed? And what are the potential pitfalls? This forces you to think about the bull case and the bear case. For example, for a fast grower, the story might be, this company makes the best vegan cheese, and as more people adopt plant-based diets, their sales will explode. The pitfall? A huge food company like Kraft could launch a competing product and crush them. Thinking this through gives you a much clearer picture. After the 2-minute drill, it's time to look at some numbers. But Lynch insists you don't need a degree in finance. You just need to look for a few key things. We've already mentioned the PE ratio. For most stocks, you want a PE that's reasonable for its category and its growth rate. A very useful Lynchian metric is the PEG ratio. You take the PE ratio and divide it by the company's earnings growth rate. A ratio below 1 is generally considered good. It suggests you're paying a fair price for the growth you're getting. Next, and this is critically important, you have to look at the debt. Lynch had a strong aversion to companies with a lot of debt. A company with a clean balance sheet, meaning little to no debt, can survive tough times. A company loaded with debt can be wiped out by a small hiccup in its business. You can find this on the company's balance sheet in their annual report. You don't need to be an accountant. Just compare the total debt to the company's total equity or assets. If debt looks high, be very, very careful. Another thing to look for is cash. Does the company generate cash? This is different from earnings. Earnings can be manipulated with accounting tricks, but cash is king. A company's cash flow statement tells you where its cash is coming from and where it's going. The healthy company should be generating cash from its core operations, not just from borrowing money or selling assets. Lots of cash is a huge safety cushion. And don't forget the story. The numbers are a snapshot of the past and present, but the story is what tells you about the future. What are the company's plans for growth? Are they opening new stores? Launching new products? Expanding overseas? Read the company's annual report, especially the letter to shareholders from the CEO. Does the CEO sound transparent and realistic? Or are they full of hot air and jargon? A little bit of common sense goes a long way here. So, let's say you've done all this. You found an idea in your everyday life. You've categorized the stock. You've done your homework, checked the financials, and you understand the story. Now, you're ready to build a portfolio. Lynch is not a fan of what he calls diversification, owning so many stocks that your portfolio just mirrors the market. He believes you should only own as many stocks as you can reasonably follow. For most people, that's probably somewhere between 5 and 15 companies. Each quarter, when these companies release their earnings reports, you should be able to take a few minutes to check in on each one. Is the story still intact? Is the fast grower still growing fast? Has the turnaround started to turn? If you own 50 stocks, you can't possibly do this. Your portfolio becomes a garden. If you have too many plants, you can't water and weed them all properly. It's better to have a smaller number of plants that you can give your full attention to. This brings us to one of the hardest questions in investing. When to sell? People get this wrong all the time. They sell their winners too early to lock in a small profit, and they hold on to their losers, praying they'll come back. This is like cutting your flowers and watering your weeds. Lynch provides a clear framework for selling, and it has nothing to do with what the market is doing on any given day. You sell a stock when the fundamental story has changed. For a slow grower, you might sell if they cut their dividend or if their business starts to lose market share, suggesting it's no longer stable. For a stalwart, you might sell if its PE ratio becomes dramatically overvalued compared to its history, or if the growth starts to seriously decelerate. The big gains have been made, and it's time to move on. For a fast grower, this is critical. You sell when its amazing growth starts to slow down. The signs might be that sales in its existing stores are flattening, or its expansion into new regions isn't going as well as planned. Once a fast grower becomes a slow grower, its stock price will get re-rated by the market, and you don't want to be holding it when that happens. For a cyclical, you sell when the cycle has peaked. Business is booming, the company is making record profits, and everyone is optimistic. That is your signal to get out because the downturn is inevitably coming. For a turnaround, you sell when the turnaround is complete. The company is back on its feet, its debt is manageable, and it's profitable again. The story is over. And in asset play, you sell when the market finally recognizes the value of the hidden asset, and the stock price reflects it. What Lynch is teaching us is to separate our emotions from the decision-making process. The market will be volatile. It will go up and down for reasons that have nothing to do with your specific companies. Don't sell just because of a scary headline or a market panic. And don't sell just because a stock has gone up 20%. If the story is still good, let your winners run. Stick to your research and the story of the company. Finally, Lynch dedicates a part of his book to all the stupid things investors do to lose money. It's a brilliant and funny section because we can all recognize ourselves in these mistakes. One is thinking, if it's gone down this much, it can't go any lower. Oh, yes it can. A stock can go from $10 to $2 and then from $2 to $0. The fact that it has already fallen means nothing if the business itself is failing. Another classic mistake is, if it's gone up this much, it must be a great company. This is chasing performance. You're buying a stock just because its price has gone up, without understanding why. This is how people end up buying at the top. You have to do the research first, not after the stock has already had a huge run. He also warns against avoiding a company just because its name is boring or silly, like Consolidated Rock or Bob Evans Farms. Some of the best investments are in dull, simple businesses that nobody on Wall Street wants to talk about at cocktail parties. A company that collects trash or makes bottle caps can be an incredibly profitable investment. He loved these boring companies because they were often overlooked and undervalued. Lynch also cautions against believing everything you hear from experts. Many market forecasters and economists are notoriously bad at predicting the future. Focus on the facts of your individual companies, not on grand predictions about where the Dow Jones will be next year. Nobody knows. And it's a distraction from the real work of finding good businesses. In the end, the message of One Up on Wall Street is one of profound empowerment. Investing isn't some dark art reserved for a select few. It's a discipline that rewards common sense, patience, and a little bit of investigative work. You have the ability to find great investment opportunities in your own backyard, long before they become Wall Street darlings. By categorizing stocks, doing your homework, and understanding the story behind your investments, you can build a portfolio that has the potential to outperform the experts and secure your financial future. It's about trusting what you know and then having the diligence to verify it.